Welcome to another Helix strategy review. We do this every Tuesday at 11 o'clock UK time. So if you haven't attended one of these in the past, feel free to join us every week on Tuesdays, 11 o'clock UK time. Right. So what are we looking at right now? Uh, I think I'll give a brief update around how our focus has been evidence based, observing the market, um, aware of the macro developments that are taking place, uh, and focusing on our thesis, which is ecoeconomics. You've read my books, most probably, and these books kind of guide us in terms of how our thesis and trading strategy for the week should be structured, how we should be generating that uncorrelated high returns for our investors week on week. So, given the thesis, we are looking for companies that are highly profitable and highly sustainable at the same time. So, these are not the firms that are going to drop environmental targets at the first possible opportunity, right? So, that tells us otherwise, right? And at the same time, when we look at it, these are companies that have had sustainability programs going back 10 years, 15 years, 20 years, whatever, right? So that's the sort of eco leaders that we kind of look at, and that's how we kind of progress through this. So, so today we're going to be looking at the recent economic developments, the major markets, US, UK, the European Union, India, parts of APAC, Middle East, the various macro indicators. What is the sort of litigation risk? Because there is a litigation risk related to environmental factors. There is a litigation risk with respect to the governance factors. So we do give it a lot of thought in terms of how this works. And many of the uh, trade tensions, tariffs, etc. This likely impacts corporate earnings. So we are watching the corporate earnings very, very carefully. So if you listen to the earnings calls, companies will tell you um, pretty much what they see as forecasted risks and how they are likely to handle that, etc. So as I said, we are not we are not experts in all of this. We didn't invent this process. What we are doing is we are observing the market. We are learning from it. We are taking cognizance of the various macro indicators, the data that is getting released, and then we're making those decisions along the way in order for us to stay profitable and in order for us to deliver that uncorrelated high returns to our investors week on week. Um, I'll also walk you through how we are currently positioning our core strategy, the core portfolio, which is based on ecoeconomics, then our various satellites and our overlays that we use. Right. So first of all, looking at the U.S. markets, economic and policy update. So the first thing that we look at is looking at the recent inflation data. We can't just look at inflation data alone, but so we look at the CPI and the PPI numbers in uh, you know kind of combination with this. So if you look at CPI and PPI numbers, downside suggesting some inflation is easing. Uh, Markets have been on the edge yesterday because of a number of things, right? One is, uh, uh, I think we can say trade tensions, tariffs related to this, but fundamentally there is economic weakness, and that led to credit rating downgrades. Fitch and Moody's have downgraded. Has this happened before? Yeah, it's happened before. Post COVID, there was basically a downgrade. the outlook is negative. And then in the past 2011, 2011, if I'm right, it's happened in the past. Uh, there is concern around the US sovereign debt, the treasuries, which in a lot of ways we all use as a risk-free rate. Right? When we want to compute our portfolio returns, we use the US treasuries as the risk-free rate. And now the risk is coming into the risk-free rate. So is there risk or is it risk-free? Right? That's the key question that I would ask. And I would say it is risky, right? Uh, why do I say that? It's not because some rating agency comes in and then says, okay, fine, I'm going to downgrade it. I care a damn about the rating agency. Really, their business model is kind of well known to me, and I don't really give it a lot of emphasis on that. Um, what I'm really worried about is the fact that the household savings rate has declined year on year in the US. It's at a multi-year low. At the same time, fiscal deficits are on the higher end. So, uh, so the real risk to the U.S. economy is beyond the credit rating and looking at the actual numbers. But then you have tariff announcements, which go and which basically help deepen the crisis, not solve it, right? Uh, in all fairness, we had such kind of idiosyncrasies here in the UK as well. For all of you who remember Liz Truss and Kwasi Kwarteng, yeah, idiosyncrasies do exist. Such kind of things do happen. But then the UK system was very efficient in a sense that we had the checks and balances to throw them out and bring in a new prime minister, a new chancellor. The US doesn't have that, right? Uh, So, so literally, it's a case of a manufactured crisis. So, how do you solve the crisis? I think what is going on right now is to deepen the crisis before trying to solve it. Right? I think that is that is the primary kind of concern that we have. Um, the tariff related easing with China, I see it as temporary until parties come onto the table, agree on a permanent sort of a deal, and keep it aside. You don't want tariff being mentioned for the next few years at least. That is what we had with the WTO and with all the free trade agreements, etc. Tariffs were not being talked about a lot, and it was kept pretty much under control. That meant that the markets can navigate through more easily. Um, from a monetary policy perspective, uh, rate cuts likely second half is what I kind of expect. Uh, remains kind of elusive at the moment, likely to be seen in the second half. What we are doing is, from a Helix perspective, we are holding on to a short duration bias on treasuries, um, and we are maintaining exposure to real asset linked equities. Now let's go into UK and EU. I think the first thing to talk about is the fact that the UK and EU agreed on a post Brexit deal, uh, which brings a lot of things into focus. There is trade. So, in the past few years since Brexit, many of the UK businesses have had extensive red tape and I would say a lack of access to their largest trading market. Similar situation with European firms, but more so for UK businesses. But now that will ease, and that shows that there will be more momentum because, like it or not, the EU was our largest trading partner, and we lost that with Brexit. Now, now things are kind of coming back in place. What's happening in the EU? If you look at the PMIs, it shows some. I can maybe say lukewarm. Uh, expansion in the services not really good, and there is a contraction in manufacturing. In Germany, which is the EU's largest exporter and biggest manufacturing base, industrial production is still under pressure. Um, what they're really trying to do is can we bring in green incentives to kind of bolster the capital investment into German manufacturing, which I think is in the right direction given that there is a green twist to everything that the EU is looking at. ECB possible cut in June, but that is, I would say, based on the wages data, the unemployment data, etc., which will then guide us in terms of how that goes. In the EU, a large part of the problem is not really the goods and services inflation. What we are seeing also in the UK, but um, we are really bothered about asset inflation, right? Not a lot gets talked about it, but that is one of the reasons why we are maintaining a modest exposure to the EU. If you look at the UK, uh, inflation likely to ease in the UK. Um, I would say the Bank of England's speeches, the commentary seems to be going towards hinting at rate cuts. They already did 4.25 more recently. There could be further rate cuts. Maybe September is what I expect from what I see. Um, the UK is definitely a big beneficiary from this trade deal that we're talking about. The UK has also done trade deals with India. It has also done trade deals with the US. So from a positioning standpoint, the UK economy is strengthening, which is pretty good. We've been maintaining a long position on the FTSE 100, Russell. We also maintain a long exposure to the basically the Eurozone ETF, modest allocation to various UK infrastructure related plays. That's largely what we're doing in the UK and EU. Then, if we look at APAC and the Middle East, uh, from a Middle Eastern standpoint, more recent um, news is geopolitical tensions have always been there. It's always a case of geopolitical tensions. But from a Middle Eastern standpoint, oil has been kind of range bound, which is good for us, right? If things are not going beyond control, out of control here and there, then we are a little bit better, right? The OPEC is likely to meet soon. Uh, in the past, voluntary production cuts were extended in order to stabilize the prices. That has helped in a sort of long duration. China, we've always been neutral on China. Um, and one of the reasons why we've taken that stand is um, China is very well positioned, or rather, best positioned to grow in this kind of an environment. And there are some reasons behind it, right? While everyone tells you that China is communist and there's like top driven economy, etc., etc., that's not really true, right? And from what we see in the on the ground in China is the fact that uh, local governments have a lot of stimulation capability, right? And they can pretty much stimulate local businesses. We've seen, mayors who are able to connect businesses, establish a market for them, stimulate the production, get them the right kind of contacts, bring them the right investors. This does not happen in the US. This does not happen in the EU. This does not happen in UK. Happens in China. Um, Industrial production has been lagging more recently. China. Uh, there could be deflation, is what we are reading. But what we are seeing on the ground is many of the listed companies are showing earnings that are quite proportionate to where they were in the past. So, is there a real problem? Remains to be seen. Um, we will be watching earnings releases in China as we go on. Uh, we've been overweight on India. Um, we've taken exposure on the India ETF, so we've been overweight on that. We also track a number of India specific stocks which are ecoeconomics focused, uh, and we'll be updating more about that in the next few weeks. Japan, uh, I would say uh, we don't see any major catalysts near term. Um, Kind of on hold. We keep monitoring. We keep staying neutral on Japan, but we'd like to see more impetus from a sustainability standpoint. I'd say some of the reasons why I put a lot of focus onto Japan is a lot of the efficiency drive, energy efficiency, not just energy efficiency, a lot of the efficiency drive and the management frameworks for ecoeconomics actually stems from the Japanese concepts of Kaizen and um, the idea behind the Deming cycle, etc. Right, that gives us a lot of the emphasis and the fact that Japanese manufacturing has the capability to go uh, big in this space, and and that's one of the reasons why we kind of track Japan very closely. As I said, we are neutral on China, overweight on India, and we continue to hedge any oil sensitive exposures using a number of structured overlays. Next, if we look at some of the key earnings this week in the US market, we're looking at Home Depot, Lowe's. They're part of the satellite portfolio for us. Not really ESG leaders, but they kind of signal the strength from a consumer standpoint, home efficiency kind of standpoint. So, which kind of says how consumers are likely to take their discretionary spends, how they are likely to look at uh, holiday related spends, etc., over the next few months, etc., when the summer holidays come in, right? From a technology perspective, we're looking at Palo Alto Networks. We're looking at Snowflake. Both of them are tied to this, the digital interconnectedness theme, which is core to ecoeconomics, and the fact that younger generations are looking for a digitally interconnected, sustainable future. And both these companies are part of that core strategy. So we're watching that. Uh, we're looking at a number of other companies. Trip.com being one of those. Clean mobility, essentially looking at that from a clean mobility standpoint. Tourism related indicators, we're looking at this. In the UK and EU, Envitech Biogas, Germany-based company, uh, it's renewable methane. It's a key for the European energy transition. So, from the fuels of the future, we're looking at hydrogen. We're looking at how methane can be used to produce hydrogen. Looking at ammonia, sustainable aviation fuel, using um, natural feedstock as part of the chemicals industry. So we keep tracking these companies. Uh, in India, we're tracking Hindalco, and we're tracking solar industries, materials and industrial demand, and how that is likely to kind of influence the markets going forward. As you will be aware, my previous fund was Indian Urban Growth Fund. So we are well aware of the Indian market and how various industrial firms are likely to kind of capitalize on that. Uh, from our strategy standpoint, we are reinforcing being overweight in clean infrastructure and the energy transition, digital interconnectedness. We are overweight with respect to that because the younger generations demand that, and that is where the market is going. We maintain a number of tactical positions, both long as well as short, in kind of traditional retail and a number of low efficiency industrial names. So we track them from the perspective of looking at it as maybe as a tactical shot, not as a structural shot. Right? Next, we look at some of the litigations and various regulations that are coming up. Some of the things that I always talk about is the fact that the moment you put up a sustainability link on your website, you are exposed to a higher um, reputational risk, higher litigation risk. Like it or not, this is the reality, right? Um, there have been several greenwashing cases. Uh, we have tracked anywhere between, I think, 2,500 to 3,000 cases on greenwashing. Uh, Companies that are overstating their ESG credentials, and they are under rising legal pressure. And when that happens, that gives us an opportunity to take a shot, right? This is one of the reasons why we kind of track these cases very closely. Uh, Many countries have also been in trouble. So the UK was in trouble earlier. Europe right now, if you look at Switzerland, is facing uh, found to be in violation of the ECHR over the climate inaction. So strengthening the kind of basis for climate litigation in Europe. So we kind of track that, and we look at how things are going with respect to that. Um, Many of the industrial legacy firms, in reality, they have outdated business models. Uh, and when we look at financials without the right kind of ESG exposure, then we see that as a possible tactical shot. Right? Uh, that's how we kind of look at it. We on our core allocations, we always favor eco leaders, not eco laggards. So uh, we have a number of traditional industrial firms, legacy firms that are outdated business models. They have huge ESG exposure. They are exposed to litigations in a massive way. You won't believe there are many, many known names that get into massive ESG litigation, and that gives If you look at last year, many of our shorts were based on litigation, greenwashing related cases, leading to a pretty good returns for our fund. So we keep tracking that, and we basically look at how this is kind of going. Um, from a positioning summary, we remain core as always on the energy transition, clean energy, digitally interconnected, efficient infrastructure, green materials, businesses that are highly profitable and sustainable at the same time. A number of satellites that we look at, our satellite portfolios, we have tactical long positions in EVs, clean energy, sorry, clean fuels, and clean tech. We take shots on businesses that are fossil fuel related, traditional industrials, traditional retail. We take shots on companies that are exposed to ESG litigation. Um, from an overlay perspective, um, we take duration sensitive overlays on the treasuries because the US debt has been downgraded. So treasuries are no longer risk-free assets itself. So, and then we track how how is the sort of a yield disparity between long-dated and short-dated treasuries. That gives us an indication of where risk is going. There are there's always been a flight to certain safe haven assets, and when you look at it, can we consider the US Treasury as a safe haven asset at this particular point of time? That's the key question in institutions' minds at the moment. So we see some movement towards gold. We see movement towards uh, commodities, which is where we are tracking that. Uh, as always, we are not ESG. We are structural alpha. Ecoeconomics is structural alpha. And we look at ESG screened um, businesses in a different way, in a different lens, because we are forward looking. Um, and our research looks at the sort of energy volatility at the moment, and we take structural positions with respect to that. So, in kind of closing, Helix Transition Fund and Helix Research, the general partner, we remain grounded in evidence based macro and eco integrated views. We believe the convergence of policy, litigation, and earnings this week provides a high amount of signal versus the noise. So we're staying close to the market and staying vigilant and adaptive, uh, especially when macro kind of tailwinds start to shift more clearly. We have to be watchful about that. As always, this is not financial advice. Um, we are only providing information based on our own market research and investment research. We are only talking about our own portfolio. If you have questions about your investment strategy, please talk to your financial advisor. And as always, hedge funds are not suitable for everyone. It is only suitable for those who are either high net worth individuals or they're professional investors like family offices, etc. Uh, always open for discussion. Even if you don't qualify, feel free to share our research. Feel free to read our research. Feel free to share our research. Thank you. Thanks for watching. I'm open to any questions. Feel free to share that on the comments. Yeah. Thank you.